Hey, this is Sasha, and welcome to another episode here on Hungry for Returns, where I answer your trading and investing questions on the stock market. Now, if you have a question that you want me to take a look at, or you want me to answer it on video, then be sure to submit one at tradersfly.com, and you can submit one by voice and audio, or even by video, or you could even just write in and submit your questions by typing it in, and you might get featured on the show. So in today's question, what we have comes down to hedging. So let's take a look at today's question, and that is, what about, we talked about what is the purpose of hedging or a stock or a portfolio, and Frank here writes, what about when the stock which you have do go all the way you want them to go? If your hedging is negatively correlated, doesn't that mean it will cancel out the profits to some degree? So the answer to this question is yes, absolutely. When you have, let's just say you have a total or basic portfolio. And when you have this basic portfolio made up of a bunch of stocks, it could be Apple, it could be ExxonMobil, it could be a mix of different things. So when you have this basket of stocks that make up your portfolio, it could be 5, it could be 10, it could be 2 ETFs. Typically, the general rule of thumb, and I'll just use Apple for example here, the general rule is that these stocks are heading higher. Now, from time to time, they do have pullbacks, okay, and sometimes they have some strong pullbacks. And the whole point is, when you hedge your position, let's say Apple is moving really, really, really well for you, well, it's sometimes wise to hedge. And the whole point behind a hedge is to protect the things that are doing well for you. So when things get stretched, eventually they pull back and come back. So what you want to do is take a little bit of cash or capital. It doesn't have to be your full account size, but let's say, okay, this is 100% of your account. And normally you might go ahead and break that whole part into, some of it is cash. So let's say this part is cash, and then the rest is investments. Well, what you might want to do is, let's say, get rid of some of those investments, or take some more of that cash and buy yourself some protection or some other diversified fund that oftentimes moves a little bit opposite of what you typically have. Now, usually, of course, if your normal portfolio is heading higher, the other investments that you have may actually be pulling back a bit, but it's not a huge chunk of your investment. It's a small part. So that way, when things pull back, it's not as large of a loss or pain. So in this case, let's say you have the TLTs instead, where typically if stock markets sell off, the TLTs or the bonds may actually head higher. So you could see here the TLTs and bonds, continue to increase and are moving well. So you might be getting some of these, or you could say, okay, well, I'll look at like the GLD. So another thing as well. So it's been moving kind of sideways here lately, as you can see, between 110 and 130. This is the GLD Spiders Gold Trust. So it's kind of an ETF for gold. Now, the market overall has naturally been moving higher lately, but this GLD since 2013 has actually been moving sideways. So it kind of just shows you, well, it's been stable, but it hasn't been moving down and it hasn't been moving up. So if the market sells off, it's quite possible that this could actually move higher. So having some of this, or maybe some of, let's say, TLTs, which is the US Treasury bonds, could be a diversification for your general stock investment. And again, the whole point is really not just to balance it out, 50% of this, 50% of that. It's really just about reducing your risk that, hey, when a pullback happens, because it will happen, when a pullback happens, what is it that you're doing to protect yourself? And oftentimes, hey, if you have $20,000 and 5,000 of it is in something like this that moves a little bit different than the overall market, that might be a little bit more of a safer bet and a safer play. Because then the other $10,000 or $15,000 that you have is just the overall market. So again, moving your money around in different areas and different spots, in case it moves kind of one big investment moves against you, at least you have some of the other things that kind of help support you and get you through the tough times. That's really the whole point, is yeah, you might lose a little bit of money as your normal investments are moving higher, But when your normal investments are pulling back and struggling a bit, those other things could actually help sustain you and let you live through to the next day, next week, next month. So that's the whole point behind hedging, is really just to protect yourself and making sure that you're a little bit diversified without putting everything in a single basket, because otherwise it could get really scary when you put everything in one pie. So I hope this answers your question. Makes a little bit more sense, especially if you're looking at diversification or hedging. Usually most people diversify after they have a few grand in the market. So otherwise, the better approach might be just to get an ETF and kind of keep it simple. So check those out and it might work out for you. In either case, if you have a specific question that you want me to answer regarding trading or investing, then take a look at our website at tradersfly.com. Write in, ask a question by voice, and you might be featured on the show. Otherwise, be sure to subscribe on YouTube or get on our newsletter list as well so you get notified as we release new courses, products, books, and all other great free training material. Thanks again for joining me, and I'll see you next time.